Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at energy fuels.
If you find our talks useful, please consider subscribe, like, and comment underneath. So, you hear investors talk about moats all the time.
Oh, absolutely.
Usually they're talking about like a software company with insanely high switching costs, or maybe a consumer brand with absolute loyalty.
Right, like Apple or something.
Exactly. But today we're unpacking a company that holds a literal physical monopoly on a bottleneck in the U.S. supply chain.
Yeah, the analysis on energy fuels is honestly a fascinating stack of research. It combines fundamental analysis, technical flows, sentiment scoring, and upcoming catalysts.
And what's the verdict?
Well, according to the data, this represents an 8.5 out of 10 bullish investment thesis.
Wow, an 8.5. But our mission today isn't to just blindly pitch a stock.
No, definitely not.
We're looking at an objective analysis of a massive strategic transformation. This is a company attempting to pivot from being this volatile, pure-play uranium producer into a fully vertically integrated critical minerals processing hub.
Right here in the U.S.
Right here in the U.S. And to understand how they plan to pull that off, we really have to start with the physical asset sitting at the center of their whole strategy.
You're talking about the White Mesa Mill in Utah.
Yeah, the White Mesa Mill, because, in the resources sector, owning the ore in the ground, that's really only half the battle.
If that, you still have to process it. And White Mesa is the only fully licensed and operating conventional uranium mill in the United States.
I really want to pause on that word only, because the barriers to entry here are just staggering.
Well, for sure.
Like if a competitor wanted to build a conventional uranium mill today, they couldn't just, raise a bunch of money and start pouring concrete.
No way. The environmental reviews alone.
Right. The environmental reviews, the community impact studies, all the overlapping state and federal regulatory approvals. It's a process that takes decades.
Assuming it even gets approved at all.
Exactly. But Energy Fuels already has this asset up and running. It's like, well, think of it like owning the only commercial kitchen in town.
Oh, that's a good way to put it.
Other companies might have the raw ingredients, the ore, but Energy Fuels is the only Western company capable of actually cooking the meal.
And historically, they've used that kitchen, that mill, for one primary purpose, which is uranium extraction.
And they've been pretty successful there, right?
Very. The data shows that in 2025, they sold nearly 650,000 pounds of uranium. And that was at an average realized price of $74.20 per pound.
That's solid. But the risk with uranium is always spot price volatility. Like if the price tanks, your revenue just dries up.
Yeah.
Do their current contracts protect them from that?
Yeah, they do. They've secured long-term contracts that stretch from 2027 all the way through 2032.
Oh, wow. So they're locked in.
Exactly. That structure effectively de-risks their baseline revenue. So they have this predictable, steady flow of cash coming from the uranium side of the business.
Which is great, but the core of the transformation we're analyzing today is what they're doing next, right?
Right. They're taking this stable uranium facility and commissioning it for a totally new frontier rare earth elements.
Yes. The Phase 1 rare earth element separation circuit, I know that came online late last year and into early 2026.
It did, yeah. And it's capable of producing 1,000 tons per annum of NdPr. That's neodymium and praseodymium.
The stuff you need for those ultra-strong permanent magnets.
Exactly. The magnets used in electric vehicle motors, wind turbines, defense systems, all the critical modern tech.
That alone is a big deal, but the real inflection point happened on March 25th of 2026.
Yeah, the terbium announcement.
Right. They announced the successful production of high-purity terbium oxide. Let's explain why that specific date and that element matter so much. Because terbium is a heavy rare earth element.
And people often think mining just means digging rocks out of the dirt.
Exactly. But rare earths are found mixed together in a single mineral, like monazite ore. Separating them isn't like pulling iron out of a rock.
Not at all. Because they sit right next to each other on the periodic table, they have almost identical atomic sizes and chemical properties.
It is an absolute chemical nightmare to pull them apart.
Seriously.
It's like having a jar of very fine white sand and being asked to separate the salt from the sugar using only water.
That's a perfect analogy. You need incredibly complex, multi-stage solvent extraction processes to do it.
Right. And up until that March 25th announcement, the supply chain for separated heavy rare earths was essentially monopolized by Chinese processors.
Yep. So by achieving high-purity terbium oxide at scale, Energy Fuels marked the first U.S. primary production of heavy rare earth material in decades.
Which just fundamentally shifts how the market values the company, doesn't it?
Completely. Because in the critical mineral space, the actual mining part is a low-margin endeavor. The real value capture the pricing power lies in the separation and processing into high-purity oxides.
Because they prove they can separate heavy rare earths from the raw monazite ore, they create this domestic mine-to-metal chain.
Exactly. They no longer have to ship raw dirt overseas for processing.
Yeah.
They can sell the finished, high-value chemical compounds directly to high-tech manufacturers.
Okay, so that explains the strategic moat. They have the facility and they have the chemical process locked down.
Right.
But wait, expanding these circuits to actually scale up production requires a colossal amount of capital. I mean, junior mining and infrastructure expansion is notorious for being a black hole for cash.
Oh, absolutely. It's incredibly capital intensive.
Usually when a mining company needs to build a massive new processing facility, they end up diluting their everyday shareholders into oblivion by constantly issuing new stock.
Which destroys the share price.
Exactly. Yet the data shows their working capital as of early 2026 is sitting between $927 million and $1 billion.
It's a massive war chest.
Where did $1 billion in liquidity come from without destroying the share price through dilution?
It comes down to a financial mechanism they executed in the fourth quarter of 2025.
Yeah.
They did an upsized $700 million convertible senior notes offering.
Okay, a convertible debt offering.
Right. And you have to understand, for years prior to this, the company operated with virtually zero debt. They had this incredibly clean balance sheet.
So institutional investors were probably eager to lend them money.
Very eager.
But the terms of that debt are what really caught my eye. The interest rate is 0.75%.
Yep.
0.75%. In this economic environment, lending someone $700 million at less than 1% interest is basically handing out free money. Why on earth would institutional investors agree to that?
Because of the convertible nature of the notes. Institutional lenders are willing to accept a negligible interest rate because that debt can later be converted into equity, actual shares of the company, if the stock price rises.
Ah, so they're trading immediate yield for massive upside potential.
Exactly. And the demand was insane. The offering was oversubscribed 7 times over. These institutional funds looked at the roadmap for that capital and just wanted exposure to the upside.
And that roadmap points directly to the Phase 2 bankable feasibility study for their Vara Mada project, right?
Yes, and the metrics coming out of that study are absolutely crucial for understanding the bullish thesis here.
Lay it out for us.
They project an all-in production cost of $29.39 per kilogram of NdPr equivalent.
Okay, $29.39. Put that in context for us, because the cost curve is basically the single most important metric in commodity production.
It really is. I mean, if it costs you $50 to produce a kilogram and the global price drops to $40, you are instantly bleeding cash. You're facing bankruptcy. So an all-in cost of $29.39 per kilogram. That places Energy Fuels squarely in the first quartile of global producers.
Meaning their operations are among the cheapest 25% on the entire planet.
Precisely. They aren't just a viable alternative because they offer a secure Western supply chain. They are economically competitive on a pure profit basis.
So they can actually compete head-to-head with the lowest cost Chinese producers.
Exactly.
Okay, let's step back and look at the whole picture the analysts have painted here. The company has a monopoly on U.S. conventional uranium processing.
Check.
They are the first in decades to separate heavy rare earths domestically.
Yeah.
They have $1 billion in liquidity, and they have first quartile production costs.
Right.
If the underlying business is this robust, it begs a glaring question. Why is the stock currently trading a roughly 34% below its January 2026 52-week high? I mean, if analysts are upgrading it to a buy, what is the broader market missing?
So the analysis attributes this 34% pullback to a mechanical market disconnect rather than some fundamental flaw in the business.
A mechanical disconnect.
Yeah, it's a really common phenomenon when a company issues a massive convertible debt offering like they did.
Walk us through the mechanics of that. Why does issuing debt cause the stock to drop like that?
It's driven by convertible arbitrage. Hedge funds love to buy convertible bonds because they offer upside if the stock rises, plus the safety of a bond if the stock falls.
Makes sense.
But hedge funds hate risk. So to completely eliminate their risk, these funds will buy the convertible debt and simultaneously short the underlying stock.
Oh, wow.
Yeah, by shorting the stock, they hedge their position, locking in a guaranteed arbitrage profit regardless of which way the market moves.
But when multiple funds short the stock simultaneously to hedge a $700 million bond issuance?
It creates massive artificial downward pressure on the share price.
Okay, so the sell-off is driven by mechanical hedging algorithms, not like investors fleeing the company because of bad earnings.
Exactly. The technical flow analysis shows the market overcorrected following that initial issuance. The underlying business hasn't degraded at all. In fact, the macro environment has dramatically improved.
Which brings us to the momentum trigger from April 8th of this year. We saw this sudden surge of interest where critical metal stocks just traded significantly higher across the board.
Yeah, there are a few factors there. Easing energy prices, a weaker U.S. dollar, making commodities cheaper globally.
But the standout catalyst has to be the AI and atoms narrative.
Oh, absolutely. The convergence of artificial intelligence and nuclear power.
We've seen these major tech partnerships lately, like the Microsoft and NVIDIA collaboration. It's really driving home the realization that the AI revolution is severely constrained by electricity.
Data centers are just incredibly power hungry. It's difficult to even conceptualize the scale.
And because these tech giants have strict public net zero carbon pledges, they can't just power a 24/7 gigawatt AI data center using intermittent sources like wind and solar.
Right, because if the sun isn't shining or the wind stops blowing, that data center still needs to run.
Exactly. They require immense carbon-free baseload power, and that means nuclear.
And securing the fuel for that nuclear expansion puts suppliers like Energy Fuels directly in the spotlight.
They become a fundamental enabler of the AI infrastructure build-out.
And this macro tailwind is clearly reflected in the analyst projections. The forecast shows their revenue jumping from an estimated $164.8 million in 2026 to $356.3 million by 2028.
That is a massive jump. And their core operating profit, their EBITDA, is modeled to exceed $110 million by 2028, right as those Phase 2 rare earth circuits come online.
It's a very clear trajectory.
The timeline to watch is right in front of us, too. Looking at the catalyst calendar for the next 3 months, there are a couple of pivotal events. May 2026 is the Q1 earnings report. What specifically should Wall Street be focusing on there?
Well, analysts suggest keeping a really close eye on the cost guidance for their Pinyon Plain uranium mine.
Okay, why that mine specifically?
The company previously guided for extraction costs around $23 to $30 per pound there. If they can confirm they're hitting those metrics, the margin expansion is going to be massive, given that spot uranium prices are trading significantly higher right now.
Got it. It validates that the legacy uranium business is still this highly lucrative cash engine.
Exactly.
And then rolling into June 2026, there's a major structural event, the anticipated closing of the ASM acquisition.
Right, Australian Strategic Materials.
On the surface, an American company buying an Australian firm to process materials seems, I don't know, a little disjointed.
It does seem that way at first, but it makes perfect sense when you look at the physical assets included in the deal. The ASM acquisition includes a downstream metals plant located in South Korea.
Ah, South Korea.
Yeah. This is the missing link in the supply chain. And analysts argue the broader market really hasn't fully priced in its impact yet.
Because it bridges that final gap to manufacturing.
Precisely. By absorbing ASM, Energy Fuels goes from being just a domestic processor of chemical oxides to an international, fully integrated mine-to-metal and alloy producer.
That's huge.
They can take the separated rare earth oxides from their Utah mill, ship them to their newly acquired plant in South Korea, which is a highly advanced, friendly manufacturing jurisdiction, and process those oxides directly into high-strength metal alloys.
The exact alloys required by the Asian tech and automotive sectors.
Exactly. So they capture the profit margin at every single step of the value chain.
The integration is highly compelling. But, as we comb through all this data, we have to acknowledge the risks. An 8.5 out of 10 thesis still leaves a 1.5 margin for error.
Right. No investment is bulletproof.
We need to examine what could derail these projections. The most prominent bear case right now seems to be the glut narrative.
Yeah, that was highlighted in an April 10th report warning that the current boom in rare earth funding could cause a longer-term oversupply.
The logic makes sense. Western governments and private capital are throwing billions of dollars at critical minerals to break reliance on China. Couldn't the market just be flooded with supply by the end of the decade?
It could.
If the market floods with NdPr and prices collapse, doesn't the valuation model for this whole company just fall apart?
It is a serious risk, but the fundamental analysis points back to two structural defenses. First is the cost curve we discussed earlier.
Right, it's that $29 cost.
Exactly. At a first quartile production cost of $29.39 a kilogram, energy fuels can endure a low-price environment much longer than their peers.
Ah. So in a commodity glut, the high-cost producers bleed out and go bankrupt first.
Yep, and that destruction of supply eventually stabilizes the price. Energy fuels is positioned as a survivor in a bear market.
Okay, that's defense number one. What's the second?
The dual nature of their business. They are not a pure-play rare earths company. They have those long-term uranium contracts locked in through 2032. So even if rare earth prices experience severe volatility, the steady cash flow from the uranium side of the mill acts as a financial shock absorber.
Okay, that makes a lot of sense. But beyond commodity pricing, there's always execution risk. I mean, building physical infrastructure is incredibly hard.
Always.
The Varamata project in Madagascar is slated to be their low-cost feedstock engine, providing the raw monazite ore for the Phase 2 expansion. But operating an extraction site in Madagascar carries geopolitical and regulatory risks.
Definitely. They still need to secure fiscal stability terms with the local government there.
And concurrently, their domestic projects in the U.S. face standard, rigorous, overlapping state and tribal environmental reviews. There is a very real possibility that permitting delays could push the timeline for those Phase 2 cash flows well past the 2028 projections.
That's a fair point.
So if their upstream mine in Madagascar gets delayed by 2 years, does the Utah mill just sit idle?
Well, this is where that $1 billion in working capital provides immense strategic flexibility.
Oh.
If their internal ore supply from Madagascar hits a regulatory snag, they aren't permanently bottlenecked. They have the liquidity to simply go to the open market, purchase third-party raw monazite ore from other global miners, and feed that into the White Mesa Mill.
So the processing and separation revenues just keep flowing while they sort out the upstream delays.
Exactly. That massive cash buffer gives them options.
Okay, that mitigates the delay risk nicely. Now let's explore the final piece of the research, which is categorized as the speculative, unpriced, blue sky upside.
This part is really fascinating.
Yeah, the data references an April 6th report discussing medical isotopes.
The science behind this potential catalyst is just remarkable. When you process conventional uranium, you naturally have to manage its decay products. And one of the isotopes produced during that decay chain is radium-226.
And Energy Fuels is currently evaluating whether they can recover and harvest these medical isotopes using their existing mill infrastructure, right? To understand why Wall Street would even care about radium-226, we have to understand targeted alpha therapy, which is a rapidly advancing frontier in cancer treatment.
The mechanics of it are incredible.
They really are. An alpha particle, which radium-226 releases as it decays, is massive compared to other types of radiation. It consists of 2 protons and 2 neutrons.
It's essentially a microscopic cannonball.
Exactly. Because it's so heavy, it doesn't travel very far, maybe only a few cell diameters, but it carries a tremendous amount of energy.
Right.
So in targeted alpha therapy, these isotopes are attached to carrier molecules that hunt down and bind directly to cancer cells. When the isotope decays, it fires that alpha particle cannonball directly into the cancer cell, completely shattering its DNA.
And because the particle has such a short range, the collateral damage to surrounding healthy tissue is minimized.
It's a revolutionary approach to oncology, but the global supply of these specific isotopes is incredibly constrained right now.
Exactly. So if a mining and processing company can suddenly harvest a highly sought-after medical isotope as a byproduct of their daily operations, they enter a completely different sector.
It's basically an unconfirmed upside right now, though.
Yeah, you won't find medical isotope revenues baked into those analyst models projecting $356 million by 2028.
But if they successfully commercialize the recovery of radium-226,
it introduces a high-margin life sciences revenue stream. Analysts suggest this could trigger a massive valuation re-rating because the market would suddenly have to price in biotechnology multiples on top of their industrial processing business.
that is wild to think about. So distilling all the fundamental analysis, the catalyst calendar, and the risks, the target horizon outlined in the data is a medium-term hold, roughly 12 to 18 months.
Right. The strategy is to hold the position through the operational milestones expected this summer.
specifically the closing of the ASM acquisition in South Korea.
Yes, and the de-risking of the Phase 2 rare earth expansion. The expectation is that the market will gradually digest the reality of this transformation.
Investors are basically waiting for the pivot to finalize.
Exactly. Turning a pure-play uranium miner into a vertically integrated powerhouse, generating diversified EBITDA across nuclear fuel, electric vehicle magnets, and potentially oncology treatments by the end of the decade.
The ambition of the pivot is massive, but the data suggests they possess the exact right physical assets, backed by the exact right amount of liquidity at precisely the moment the macro environment is demanding it.
It's a unique convergence of factors, for sure.
As the global economy continues to deglobalize and tech infrastructure demands unprecedented amounts of reliable energy for artificial intelligence, consider this as you review your own portfolio. Is the real power and leverage in the future economy held by those who dig the raw materials out of the ground? Or is it held by the rare few who control the highly specialized, nearly impossible to replicate facilities required to actually process them?